Welcome to this new episode of Your Next Trade, episode number 25, called today C, Credit Suisse to D, Deutsche Bank. So if you've been looking and following the markets, it's mostly about the banks over the last couple of weeks. That started in the US with the regional banks. It has been spreading in Europe with the bailing out of Credit Suisse last weekend from UBS, by UBS, should I say. And now there is some pressure as well on banks like Deutsche Bank. So if we look at the chart here, this is the CDS for the 5 years for Deutsche Bank, where we move from 80 bips to more than 200 bips. To give you a bit of perspective, a similar CDS 5 years for Credit Suisse last Friday, a week ago, was trading above 1,000 bips. The issue that we have with CDS is CDS are very often traded by very few players. So it's not necessarily that liquid. It's not a very good representation of how the quality of the other parts of the bonds will be trading. So always take a bit of pinch of salt when everyone on Twitter these days is talking about CDS of Deutsche Bank and how they have been trading. That tells you that there is stress, that there is clearly stress in the banking system and how the banks have been trading, how the debts of those banks have been trading. Does that mean that those banks are going to go under? Not necessarily, but the end game is in that sense. We know that the balance sheet of the banks are very much different from 2008. They are in much better shape. But a crisis is always different from another most of the time. And here, if we look at Deutsche Bank, they had very good results in 2022. We know that they have a good Tier 1 ratio, that the assets are in much better quality. So that is not the question. And don't get me wrong, when I'm using a title from C Credit Suisse to D Deutsche Bank, it's a bit of attracting people. I'm not saying by any means that Deutsche Bank is going to go under. What I'm interested here is how the market is pricing things and how those crises are evolving. And this is the perception of the risks and how people could be, and how investors could be flying from one risk to another. So now the headlines, the lights are on Deutsche Bank in Europe. Again, I don't think this is the same issues, but we saw last weekend and we saw 2 weeks ago that everyone was saying, look, Credit Suisse is fine. Not everyone, but many analysts were saying Credit Suisse is fine. They got a Tier 1 ratio that is very strong. What banks are facing these days is they are experiencing outflows. Why is it happening? It's something that we have been flagging over the last 3 to 4 months. Before, what we had is there was no alternative, what we call TINA, T-I-N-A, no alternative where literally where the bonds, when the yields were at 0%, people were going to find some returns going for stocks. Now these days, when you get the 2 years, the 5 years, the 10 years that are trading at 3%, 4%, 10% in the US, if you get deposit, if you get cash, you get more alternatives, and these alternatives will be, for instance, the T-bills. So if you are like me, you will be putting your money at the bank. If this bank is not offering any yield on your deposit, you will have a tendency, obviously, to move that money away from that bank to be putting, for instance, into T-bills. And that has been one of the reasons that the regional banks have been suffering, because they have been seeing some outflows. The cornerstone of our economies have been the banks, and the way banks have been doing businesses for years is they rely mostly on deposits, and they are using those deposits to be offering loans and to be as well giving cash, 5 years, 10 years visibility for investment. That has been the struggle that we have been experiencing, and what is pretty clear in this market is the old and the names, the suspicious name that we had in the past, and we had Credit Suisse, we had Deutsche Bank, but you can be making the same story about SocGen in France, or some Italian banks. And again, I'm not saying that this is we should be going short of those things, and this is the way to go. But unfortunately, this is how the market is behaving. Unfortunately, or not unfortunately, this is how the market is behaving. But don't get misled by only looking at CDS. This is not the good way of looking at it. What is pretty clear is the market is under a lot of pressure. Rates are telling us that we are going into a recession, and the other asset classes, for the time being, are giving us another picture. So let's look at the year-to-date asset performances, looking at stocks. So we see that most of the developed market are in a small positive to positive territory. So S&P 3.4%, Nasdaq double digit, Europe is close to double digit as well. If we look at FX, there is not a lot of volatility. There is volatility, but it's between a 1 to 3% trading range for most FX. So this is, if you look at the other asset classes, as I underlined last week, this is one of the asset classes that is moving the less. Crypto doing very well over the last couple of weeks and since the start of the year. Gold very well. This is the risk off that as we have experienced since the regional banks. WTI, again, same story, slowdown that might be happening soon, going into recession, versus what the market was pricing at the start of the year, which was China will be reopening and a lot of demand will come out of it. Natural gas and European gas. So now let's look at the week-to-date asset performances. As I flagged last week, so the question has been, QE, no QE. Technically, this is not a QE from the Fed, but that tells you one thing. That tells you that there is liquidity. There is more liquidity going into the system. That we go back into some setups that many investors had in the past, which is the first action of the Fed is to put liquidity, and very often is to do quantitative easing. And what has been happening hand in hand with quantitative easing is a rally in asset classes. So what we've experienced, and I've been flagging that very clearly last weekend, is despite Credit Suisse going under or having the help of UBS, we could see some risk on. Why? Because people will be flagging and saying this is as before, and let's go for the risky asset. So this week across stocks, we've seen both in Europe and the US 1 to 2% move, and actually that was a bit more during the week because we came down a bit, but that tells you about the risk on. So we have some of the worst picture if you look at the headlines of the regional banks, if you look at Credit Suisse, and in the meantime stocks are doing pretty well. So there is a divergence between the news and the price action. Here FX again moving into a 1-2% trading range. Then I would like to go into the year-to-date industry performances, not that different from last week, where semiconductor, technology, social media. So it's very much like the 2020 moves where people were allocating a lot of money into those spaces, regional banks, oil services on the negative left-hand side. So week-to-date industry performance, more interesting, solar, social media, silver, gold miner. So you do have like a bit of both risk on and risk off. So risk off, which will be silver and gold miner, and in the meantime a lot of risk on with solar, social media, sectors that could do normally not that well in a risk off. But as we're going to see later in some slides, clearly market participants have been going some what they perceive so far as a flight to quality. And that has been the reason why the market has been doing so well. So year-to-date sector performance, telco, consumer discretionary IT doing very well. So we see technology double-digit, 17% other end of the spectrum, energy, obviously, with WTI struggling, financials with the banks, utilities, with a lot of volatility with the bond market. On the week to date industry sector performances, telco doing well, so a bit of real estate and utilities. So bonds, anything that has been bonds, has been struggling for the week. Now, we've been talking a lot about stocks, but what about the rates market? So this is where really the volatility has been in the market, the stress in the market. So now the US 10 years is standing at 3.38%, almost flattish on the week, down 50 bips for the year. But really the picture that is important is the 10 versus the 2. So we used to be very negative, where we went down almost 110 bips. Now we are negative 40 bips. So there is now a steepening of the yield curve. Very often when you have, if you look at history, if you have for quite a long time, inverted yield curve, that tells you that a recession is coming. And when you start to see a steepening, that means literally in the next 3 to 6 months, recession is coming. So we had a big move in bonds. I just changed the usual tab that I have for the euro dollar, and I put the euro dollar in terms of yields versus the pricing of bonds. So if you look now at the December 2023 euro dollar, so that was on the 10th. The market was spreading 5.10%. Now we are pricing 4.1%. So overall, if you look since the pressure that we had on the regional banks, market participants are expecting the Fed to be cutting rates by 100 bips versus what we were expecting, or a differential of 100 bips, 1% over a couple of weeks. And if you can see here, all the cut that are expecting by the market, that you don't do cut now because this is not about inflation. This is not because the market is saying inflation is going to be plummeting. It's more obviously because the market is expecting the US economy to go into a recession. So what we have from the rate market is recession is coming. What we have from the stock market is, don't worry guys, everything is fine. At least for the time being, market is up for the year, 2 to 10% in the US, roughly 10% in Europe, is up on the week. And overall, the picture for volatility is volatility each time that volatility goes into the high 20s, roughly into the 30s, as we've seen on Monday and on Tuesdays. This volatility is sold off. The reason is when you have implied volatility at 25-30%, you need a very high realized volatility. In other words, the market, when it is happening, is overpricing, is over, let's say, the expectations are too high for implied for volatility to be that high, and you start to see volatility being dumped during the session, and the cash, the equity, the stocks will go up. So now what I'm interested now is going quickly into the technical analysis, and we're going to be discussing the week and the next week. So what about stocks? What about the S&P? So this is the S&P futures looking at ES. We're still above something that used to be a resistance. There is no support. We have been trading in the range, and the magnet is very much the same, which is the 4,000 level. 4,000 level. So we close on the S&P roughly at 4,000. So that has been a magnet for a few weeks and a few months now. So a lot of positioning. We know that at the end of this quarter, so on Friday, we get the 4065 magnet from the JP Morgan big fund. So that is a natural magnet. Is going to be hard so far to be moving away from this level. On the Nasdaq, what we could see is actually the Nasdaq is outperforming the overall market. So there has been an appetite for technology stocks, for the big 5 to 7 big companies. The reason is so far the market is having this perception that those big names are safer. than the rest, and that can be seen as well. If you look at the Russell is struggling, and if we look at the Nasdaq versus the Russell, this is something that we flagged over and over the last 2 to 3 weeks, the outperformance of the Nasdaq versus the Russell. So people are moving away money from the Russell, the banks. So if you think about in terms of money, I think I read somewhere that banks, Russell, roughly $500 billion moved away from this from the Russell to move into the Nasdaq, to the big Meta, Amazon, Apple, Microsoft, and you can see this outperformance that started on the 1st of January. Emerging markets / China, we had a bit of a bounce. There is still, I was expecting more headlines coming from the visit of China in Russia at the start of the week. Not much happened. We're going to have the Chinese PMI on Friday. We don't have that much news coming from China since the reopening and the excitement of the reopening on January, February. So that is something to follow. Stock 600, so that is for Europe. I'm still short. I still believe that it will come down. DAX, similar picture. There is a bit of deterioration. CL1 as a flagged, so we went into the 65, 66 level. You've seen some headlines of hedge funds, complaining that it should go higher. The story is now the same. We have been trading in the range of the 72, 82 for quite a long time. We broke that level. If we don't have any positives on the economy very soon, you can make sure that we're going to be challenging the low 60s. Copper, the picture is a bit better, so there's a bit of hope for the CL1 for WTI. So up, and euro dollar trading in a range. Actually, that was quite a funny week if you've been trading euro dollar. So there was a bit of strength of the euro midweek that kind of fade away at the end of the week. So we went to 109 and above, and we came back a bit. So I'm more interested into the next slides, looking at what happened this week. So the week started on the Credit Suisse bailout. So that was announced just before the reopening of the futures on last Sunday. So UBS bailout or bought Credit Suisse. There was a bit of craziness on Monday morning. The reason why was that the 81, which are bonds that are owned by banks, that were supposed to be above in terms of classification of creditors. Actually, in one of the, if you look at the contracts of the 81 of Credit Suisse, that was saying that that was a bit different from the rest of Europe. So there was a bit of people being upset. So here I'm giving you one of the bonds of the perpetual bonds from Credit Suisse. Overall, that represented 17 billion. So that's quite significant. And you could understand why UBS, when they bought back and when they sat with the regulators, that they say, we don't want to have those 17 billion bonds on our balance sheet. But a lot of investors, especially in Europe and the US, that were thinking that, if these bonds were not paid back, actually the shareholders will be wiped out as well. So a bit of frustration for many hedge funds. But if you don't read all the rules, this is what is happening. Then we had the FOMC meeting. So FOMC meeting on Wednesday. I was a bit sick on the day, so I listened to the conference, to the Powell conference on Thursday morning, and I have to say, it was pretty, you could tell that Powell is under a lot of pressure, which I can understand. I didn't feel very confident about what he was saying, and you could really understand that the banks are facing huge pressure. So on one hand, we got the rates markets in turmoil, and on the other end of the spectrum, we got the stocks that is telling us that everything is good. So if you look at the picture, for instance, in Europe, stock 600, so Credit Suisse, We started the day, so that was on Friday last week. We opened the day very weak, then we started to rally, and then we went even higher. So on the week, we are up on the week, and that's just to give you a bit of understanding of what is the market doing these days. Is on one hand, one of the biggest banks in Europe was bailed out, so quite a negative. That tells you that there is pressure on the banks, and you can say whatever of this is different of 2008. Still, there is pressure on the banks, but in the meantime, stock market is giving you quite a rosy picture or an okay picture. One of the reasons is obviously investors are going for flight to quality, and I don't know if quality is the right terms, but if you look at the US, we know if you look at the top 5 stocks in the US, so if you look at that chart, you can see that the concentration is getting bigger and bigger. So now 20%. Those 5 top stocks are making more than 20% of the S&P 500. So you don't need that much of performance coming from those 5-7 names for the S&P to do well. So here I give you this tab here. Compare the price on the 8th just before the crisis versus Friday, so versus yesterday close. As we can see, Apple is up 4%. Microsoft 10, Alphabet 12, Amazon 4, Nvidia 11, Tesla 5, and Meta/Facebook 12%. So overall, all those names, that is over the last couple of weeks and year to date, Nvidia is up 83%. So the S&P will be down for the last couple of weeks, where in the meantime, those stocks will be up 5 to 10%. And on the year to date, when the S&P is up 3.4%, the S&P through the SPY with the ETF, year to date, those stocks will be up double digits. So if we look at the weighting of those stocks from Apple to Nvidia, again, that makes 21%. So if those stocks, that makes 21%, are up over the last couple of weeks, 5 to 10%, that explained a lot why the market is flattish. So some people will say this is flight to quality. Be always careful with the flight to quality. How much are you paying? And at the end of the day, from experience, is when your portfolio is under a lot of stress, so you have to sell all your dodgy stocks. But if there is more pressure to come, you'll have to sell some of your winners. It comes with outflows if you are a hedge fund. If you're a hedge fund and you're down 5% on the year and you start to experience outflows, you need to trim your position. So first reaction has been kind of flight to quality. That will be those 5 to 7 names. And if you look at Europe, that will be exactly the same. Investors will be going into LVMH, they will go for L'Oreal, they will go literally for the big names. But actually what was interesting for the week, especially in Europe, many industrials over the last couple of days started to suffer. So if you look at the big names like Siemens, like if you look at Schneider, those names were down 3 to 5%. And that tells me that actually the underlying is now changing, and we will see further weakness. So what about the catalyst going forward? Again, I think if you look at the banks, you have to be looking at the banks, obviously. And I'm not, I don't want to do a doom and gloom and saying the end of the world is coming. This is really not the idea. I've been trading for long enough, but that tells you where the pressure could be. And it's a domino effect. It started with the regional banks. We had Credit Suisse. Hopefully, it's not going to get bigger, because literally, when you go short of a bank and it starts to come down a lot, you're quite happy with your P&L, but you kind of feeling that something wrong is going to happen, and it's not necessarily the best feeling that you're going to have. So what about this week? So looking at the banks, looking at the end of the month and the quarter, so that will be for Friday. As always, we could see some rebalancing. Some people, some funds, what they're going to do is, as always, they want to pretend that they were long Nvidia, Apple, Microsoft, and all those winners. So those winners, this outperformance could be even more extended, because you want to show up at the end of the month that you were long, even if that was not true. And we could see some rebalancing based on the 60-40% of the funds, looking at how the bonds have been doing versus stocks. In terms of macro, we do have like Germany, IFO, we have some house prices, but more importantly, we got on Thursday the German inflation, and more importantly, the PCE on Friday. So PCE, I keep on saying that over and over, PCE is the biggest headline or the biggest data that the Fed will be looking in terms of inflation, even more than the CPI. So on Friday, PCE and European inflation, Chicago PMI and Chinese PMI. So Friday is going to be very busy. Not much of earnings. We do have like 3 to 4 names. So look at potential headlines. So we've seen today, so just before I started recording this video, so there was some headline that Rocco's hedge fund had to degross his positioning. I think it's down 10 to 15% for the month. So when we have so much moves in the rate market, keep in mind that the rates are very liquid. They trade overnight as well. So there is a lot of hedge funds, big players that will be putting huge positions. And what we experience over the last months or so is the 99.99% move. So in terms of value at risk, if you're familiar with value at risk, if you start the day, if you are a prop trader, if you're a hedge fund, you start the day, you see what is my book made of, and you'll be looking at something, for instance, that has built 25 years ago, which is the value at risk from JP Morgan, not only. And value at risk is not only, but it's based on distribution and how, looking at the last 250 days, your risk is at. And obviously, it's based on 250 days or more of historical numbers. But when you get an outlier, this number is not taking into account this outlier. So what the rate market experience is outliers moves with big positions, and that means there is probably still blood, and we're still gonna have headlines. And we are talking hedge funds. We had some blood coming from regional banks. We could have some blood coming from, unfortunately, insurers. We could have some blood coming from commercial real estate. All those things are pretty well flagged, but that doesn't mean because it's flagged that it's not going to have more effect on the market. So look at Deutsche Bank, look at the banks, look at regional banks, look at commercial real estate, and as well look at how those sectors, industries that have been outperforming so far. We are talking tech, we are talking the FANG versus the market. If they are still doing, if you start to see a change, a rotation in the market, that tells you something as well. What about the pricing, the implied volatility by the market? So last Saturday, when we look at the same at the money straddle for the S&P, market was expecting a 3.1% move versus a 2.2% as of Friday yesterday, which is very similar to the levels that we had 3 or 4 weeks ago at 1.9%. So in terms of volatility expectations, we are back to pre-crisis level. So the equity market is kind of living in the la-la land versus the rate market. If someone has to catch up, even a reversion to the mean, equity will have to move somewhere. Finally, Fed balance sheet. So the balance sheet, again, we discussed that a couple of weeks ago. This is not QE, even if the size of the balance sheet is going up. But that tells you as well that very often what has been happening in the past is when the Fed has been opening liquidity and offering swaps, the next move has been more quantitative easing. So this is for me for the week. I hope that I've not been too slow. For me, it has been a bit a slow week. I've been a bit sick, but overall, the picture is the same. Stocks have been doing pretty well, as I've been warning. Be careful on being on your exposure, gross and net exposure. So I think recession is coming. I still believe that a recession is coming. We are still very often market participants coming back into the same mindset, which is the Fed is pivoting, this is quantitative easing. I think it's going to be much harder to do quantitative easing, and actually we could see some more damage. And if you look across asset classes, rates are really into trouble, and that could tell us something about the market. I hope it helps, and hopefully I'll see you next week, or actually later than that. Thank you very much. All the best. Bye bye.